Welcome to Fidelity Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lucas de Porbe. I'm Fidelity's global cross-asset specialist, and today I'm pleased to be joined by our portfolio managers for our Global Future Leaders Fund. We've got James Abela and Maroun Younes. Welcome.
Hello, thank you.
Hi, good to be here.
Fantastic. So, global mid-caps, it's an interesting one. A lot of the audience would be probably familiar with Australian small-cap stocks, Australian mid-cap stocks. So when we think about mid-caps on a global level, what types of companies are we thinking about? What's the universe of stocks are we dealing with?
The thing about the global mid-caps and small-caps is a lot more maturity than Aussie. Aussie small-caps, and I've done research on this talking about the toddlers in the Australian market, companies that are under 3 years old, as in the technical toddler term. And it gets to over 50% of the market in bull markets or very momentum-y markets. So it happened in 2000, happened again in 2007, happened again in 2016. That's under 3 years old as half the market. Mm-hmm. But the age of global mid-caps are like in the 30, 40, 50% range. And I've actually done the study. 100 stocks in the universe of our 800 names in the index are over 70 years old. So they've been around for a long time, and the average age is between that 30 year old range. So they're very mature. If you think just an age wise of a corporation, they're very mature. The balance sheets are strong. The markets are established. The managers are very advanced in their thinking and their process and their product and their markets. So they're very mature, and the diversity is also very broad in terms of it doesn't dominate by the Australian market in terms of financials and resources. It's very diverse. So that just gives you an idea of scale and age. And they're around 20 billion market cap as average.
Yeah, wow. Okay, so we're not sort of dealing with your sort of little speculative stocks here. What would be sort of equivalent if you think about an Aussie stock in our Aussie universe of it? If you compare it, maybe in the large cap Aussie, which ones would sort of fit the sort of mid cap mold on a global level?
To be honest, most outside of, I guess, the big four banks, Macquarie, CSL, those sorts of names. So basically, as you go outside of the top 20 or 30 names in the Australian market, the rest would be equivalent to what we would look at in our global mid-cap universe. So just to give you some idea, the largest in our universe is around 40 billion US market cap. Which is equivalent to about 60 odd billion in Australia. So there are only a handful of names in Australia that would not be part of our mid-cap universe. So we are really, going back to James's point, talking about really well-established businesses that have been around for a long, long time.
And in terms of the sector composition, so if you think about, say, the global equity universe, particularly large caps, many of our listeners would be familiar. The big tech names dominate. It's a very concentrated, I guess, universe. What does the mid cap part of the market look like? Is it as concentrated or is it more diversified?
It's much more diversified. So if you look at the index level, the index concentration is very low. So the top, Maroun mentioned, 30, 40 billion market cap is like 20, 30 bips in the index. So that's quite small. Then also the industry diversity is also very high. So it's industrials 20%, financials 15%, tech nearly 20%, consumer 10%, healthcare 10%, REITs 10%. So it's very diversified. And typically for us, we are looking for global future leaders. That's the goal of the fund.
Yeah.
And that's typically in four universes, being consumer, tech, healthcare, financials, or industrials. Those big five dominate sort of what we typically invest in, which is about 2/3 of the index. So the opportunities are very large. There's 800, 900 stocks in the universe. So potentially we're looking at a universe of 300 sort of names that we could potentially buy from in our universe because it fits our metrics, it fits our filters, and it's in those kind of five global growth, structural growth sectors and universes.
There's a lot of noise at the moment around global mid caps and small caps for that matter. Why are we hearing a lot more noise around this part of the market? I mean, there's some commentators are pointing to valuations are looking attractive. Others are pointing to the fact that a soft landing scenario is actually quite good for these type of stocks. What are those things that are making this part of the market look attractive at this point in time?
Yeah, look, I think both of those. I think firstly, the small and mid-cap universe generally more exposed to the global industrial cycle. And so as we're seeing now, particularly coming out of this reporting season, things are looking, incrementally a little bit better. And so, some people are looking at, and also it's worth mentioning, this part of the universe, the small and mid-cap space, tends to have a higher beta. So if you are a little bit more positive about the forward-looking macro for the next 12 months, then this is an area that you usually want exposure to. So that's sort of on the outlook side, but also on the valuation side. This is the biggest discount between the large cap universe and the small and mid-cap universe in over 20 years. So I've just looked at valuations over the last 20 years. The last time we saw this sort of level of discount was in 1999, 2000, which was the height of the dot-com bubble. And then the small and mid-cap universe went on to outperform the large cap universe over the following decade. So, combining those two together in terms of outlook as well as quite a sizable discount, it's quite an opportune time, we think, in our mind, to be looking at this part of the market.
Is there any sort of, what's the key driver of the valuation discount? Is there one sort of central reason why there is such a deep discount at this point in time?
I don't know if there's one central reason. I think there's a few of them. Firstly, obviously, the large cap universe, particularly over the last sort of 5-6 years, has been led predominantly by a handful of exceptionally large names in the US, the Magnificent Seven. They've been called different acronyms in the past. But those companies have just been so dominant in terms of their growth, in terms of their earnings, that a lot of flow and a lot of attention has been directed towards them. And there's been lots of other companies, particularly in our part of the universe, that have effectively begun, forgotten about or flying under the radar, or just completely neglected because they're not in the limelight.
No, that's interesting. I mean, whenever you get this big valuation dispersion, it's always interesting part of the market to look at. The interesting one is, obviously, if you think about the small cap part of the market on a global level, it also trading at a valuation discount, I guess. So what are some of the nuances between the smalls and mids? And so if you think about that, what should investors be aware of?
Yeah, look, we've done a study, and I think it's a really interesting question. And for us, definitely mid caps is where we'd prefer to be. On a 15-year basis, you look at the rolling 3-year ROE of large caps versus mid caps versus small caps, and small caps definitely kind of under delivers in that camp. So it has a rolling ROE over 3 years of between 6 and 7%, which is quite a lot lower than mid caps, which is around 10. So that's closer to large caps, which is doing around 11 to 12 right now. But on a long-term basis, mid caps and large caps are much closer, and small caps tends to be higher dispersion, higher beta, but overall, as an average, a lower return cohort. And because of that, there's definitely a preference for mid caps. But then also the total return correlation to ROE is also high, just statistically and mathematically. So you get a higher return in large caps and mid caps compared to small caps at an index level. Yeah,
right. It sort of sounds counterintuitive in a way. And also I think, when I sort of think about mids and smalls, at the moment, obviously we have a sort of soft landing scenarios that sort of seems to be consensus at this point in time. But if we do get a bit of a slowdown, from what I understand, mid caps, in terms of that drawdown,
they're more resilient.
More mature.
Market structures more developed.
Even things like leverage, for example. So net debt to EBITDA right now in the mid cap universe is about 2.3 times. Sorry, that's historically the last 20 years, 2.3 times, whereas the small cap universe is about 2.7 times. So not only do they give you better returns in terms of return on equity, they've got higher margins and generally more sound balance sheets as well.
Yeah, so it feels like it's a bit of a sweet spot in terms of the.
We think so. We call it the goldilocks, which is sort of that nice spot in the middle in between large and small, and sort of combines good elements of both.
Great. Let's move to reporting season. So it's very much. I guess a lot of anticipation around reporting season. Interested in your thoughts around some of the key themes this reporting season. And maybe starting off with what's changed from last reporting season. Are there any couple of things that you can point to that you think, okay, there's been a sort of shift in these sort of one or two, three things?
Yeah, I think for me the biggest is probably the surprising resilience of in particular the US consumer. They've held up incredibly well. If we rewind back 3, 4, 6 months ago, lots of talk about a potential recession or a slowdown. Given that the consumer had largely drawn down all their excess savings from the pandemic, and cost of living pressures, interest rates going up, etc. But what we've seen, I think, in this reporting season that's just about to finish is the US consumer has been quite resilient, and they're showing, from what we can see at this point in time, no signs of any stress or any issues to their finances. That for me is probably the biggest positive surprise. Yeah.
And I'd say it's the sectors that were dominant. So I've been talking about this for about 2 or 3 months in the Aussie context, and it's definitely the case for global as well. You got really strong consumer, technology, financials, and industrials, which are where there was a lot more fear and concern, but earnings have come through and valuations started to expand. So those 4 sectors, consumer, tech, financials, industrials, have performed well on a 1-month basis and a 3-month basis. And although the market's up, they're up more than that. And that's coming from earnings. The earnings are stronger than expected, the confidence is higher than expected, and therefore those sectors have done better than the average. So definitely I think the market's moved from like recession to soft landing to almost no landing now as consensus. And that no landing has in these 4 sectors become this constructive recovery path. And that's why you've had the markets continue to move up because of earnings and multiple expansion, because the confidence has led people to go from short-termism when you get it, recession fears, you go very short-term and short duration, to very long duration and your movement moves out, which means you can focus more on the long term, which is where you also allow multiple expansion.
Yeah, more on the growth.
Yeah, more on the growth and more on multiples. So that's what's been happening. Whether it can continue, there's lots of concern now about the US market, because the US market has been incredibly strong.
Yeah.
But if you do look at the ROEs of the US market and the returns and the growth outlook, they are quite strong. So it's hard to see it fall in the short term because confidence has really improved and fear has gone to, not greed yet, but certainly fear has gone out of the market.
Right.
And now we're going to a much more constructive, positive outlook for the world.
Just in terms of reporting season, if you sort of reflect on your own portfolio, are there any stocks that sort of come to mind in terms of that really sort of surprised on the upside?
Yeah, one that did quite well, which we own, is a company called Quanta Services. They basically provide end-to-end project management, human capital services to a lot of different end markets in the US, including things like telecommunications, infrastructure, as well as oil and gas. And they posted a solid set of numbers, and they were one of the more positive contributors to the performance of the fund over the reporting season period. So that was one that probably first comes to mind.
So in terms of when you sort of got this environment where the market's pretty buoyant, pretty positive, it sounds like it was a very strong reporting season. One of the points we talked about earlier is valuations and how sort of mid caps look relatively attractive on a valuation basis compared to large cap. How are valuations, I mean, at this point in time where you've had some stocks run up pretty hard, that valuation argument, how, what's the risk of that sort of opportunity sort of narrowing?
It's still there, like it's still attractive. Like the index is at 16 times PE, which is not very high, like in the scheme of things. And the growth is around, 10 to 15% in a range for the next, 1 to 3 years. So that looks pretty like normal. Price to book at 2 times is pretty normal. So things don't look really stretched, to be honest. I think individual stock level, there's definitely some things we're watching, but also the portfolio balance as we try to have a valuation discipline on a persistent basis, because that's where you do get caught.
I mean, I was just going to say, James's comments, in our universe, we're not seeing that. I think your comments around seeing more stretched valuations, I think apply more and more to the large cap end of town. We're definitely not seeing that same level of valuations being stretched or questions being asked about how sustainable is this, not in the segment that we look at.
Yeah, right. Okay.
And for us, what we focus on is what you're paying for the growth or what you're paying for the superior return profile. So for us, we look at the fund, which is on around a 21 times PE. The index is on 16, so that's about a 30% premium. But the ROE we're getting is 22 versus the index at 14. So we're getting a 50-60% ROE premium. We're getting, slightly higher growth than the index, and we're only paying 20-30% above the index. So on balance, you got to look at what are you paying for that extra premium or extra growth. And we're pretty comfortable that on a portfolio basis, it's we're pretty comfortable. But we also look at it at the individual stock level to make sure we're not getting too excited or becoming cheerleaders for certain stocks or certain sectors to the point of valuation risk being too high.
Absolutely. So maybe if we look ahead beyond sort of the recent reporting season, so if we look ahead over the next sort of 6 to 12 months, what are the sort of key things we should be looking out for? You mentioned that at the moment, obviously the market is buoyant. There's sort of that fears come out of the market. How sustainable is that? And are there any things that we should be aware of in terms of risks?
Yeah, look, so I think it's probably worth just maybe starting more broadly at the macro. And what we're seeing right now is the US macro continues to look stronger than other parts, particularly Europe and China. So the US does still stand out. From a macro perspective, from a resiliency perspective, from a corporate earnings perspective. And we tend to focus a little bit more on the US because of that. But generally, I think at the margin, there seems to be a sigh of relief from the market. We've seen earnings forecasts stabilise. What we're expected to see in calendar year 2024 is in our universe, EPS growth, earnings per share growth of around 10%. Now, to put that into context, earnings per share declined about 6% in calendar year 2023. And a typical average year would sort of be in the range of +6 or +7%. So if forecasts do come to fruition for this year, then we are going to have a big step up from what we saw last year and something that is slightly above average. So that bodes well, I think, for the expectations, especially given, like I said earlier, if you rewind back 3 or 4 months ago, people's fears around sort of where we were heading. I think there's a big sigh of relief that's been breathed right now by the market, and that's reflected in the market behaviour as well. But probably one other area worth touching on would probably be Japan as well.
Okay.
Japan's been getting a little bit more attention, increasingly, I think, over the past year. Japan has historically been a very cheap and undervalued market, but has been plagued by a whole bunch of different issues, including poor governance, lots of cross-shareholdings, very stale management and boards, etc. But the regulators have taken a much more active approach in recent times. And the exchange in Japan is basically requiring companies that are trading at price to book valuations of sub 1 time to come up with a plan as to how they want to improve their valuations over time, what they want to do for things like, because Japan, the corporate market over there is quite cash rich. Balance sheets there are generally quite strong, but historically the corporates have just sat on that cash. Yeah. So the exchange wants them to improve distributions to shareholders, whether it be buybacks, whether it be increased dividends and the like, improve their governance, perhaps unwind some of these cross-shareholding things. And it's popping up increasingly on people's radar. And we've got quite a sizable position in the fund in Japan. Over 10% of our fund is invested in Japan.
Interesting, yeah.
Some interesting names there. So I think that's probably one and it's not just, I think, something to look out for over the next 6 to 12 months. I think Japan as a country, as a region is probably, it's changing, and it's probably something to look out for, for at least the next couple of years.
Yeah, because your points around Japan, there's been historically this, it's a value market, but lazy balance sheets.
The lost decades.
And not very shareholder friendly. But to your point, it does feel like there's a structural shift, and so there's a lot more opportunities. James, from your perspective, it sounds like it's all sort of looking pretty positive. It always sometimes makes me a little bit nervous when there's this sort of everything's looking too good.
Yes.
What are the X factors that you think that we should be aware of, just that could potentially derail this this good outlook?
Well, there's probably three big ones. One is politics. I think there's a lot of talk about the US presidency change or anything around US politics is probably one of the confidence sentiment shift risk is one. Two is another like valuation sort of correction where you go into, anti-quality, anti-momentum type factors and people go more towards value, more towards defensives.
Yeah.
That's, but again, I think that'll be short term. So therefore, I think you've got to focus on earnings and ROEs for the next, especially in the US market, for the next 12 months. I think if that ROE and EPS growth continues what we can see right now, then the market will keep on continuing. Otherwise, the risk is, you'll have the number two factor risk, which is something around valuation correction, which you had in tech and different little clusters. So that's what you got to look out for. I think they're the risks. But at the moment, that's why I said there's four sectors that have been very strong: consumer, tech, financials, and industrials. They're all liquidity, beta, recovery, or confidence driven. But the earnings and the returns in those businesses at an individual level are all improving, and the sectors are improving. So those sectors are doing well. But you got to look out for risks. I think you got to be we're very conscious of valuation and not, like I said, not becoming cheerleaders, especially in tech. Yeah. And tech and industrials are certainly getting up there. But we are being quite disciplined and not trying to chase things. And that's, I think, what you need to be careful of this year.
Yeah, absolutely. Absolutely. Well, we might sort of leave it there, but if I sort of reflect on some of the key points I certainly got from this conversation is that, mid-caps, at the moment, there is a valuation story there. They are trading at a discount to your large cap stocks, which, as you noted, have had an incredible run with some of those Magnificent Seven stocks. But at the same time, the quality is there. So we're not sort of in that part of mid-cap part of the market. You're not fishing in the sort of real low, small cap sort of speculative
like
part
I said,
of the market.
They're not toddlers, they're more teenagers.
And I do like that.
University medalists and really strong sort of human age, sort of 20 to 30-year-old companies in a corporate human age. You couldn't know as a parent looking at a child or a 20 or 30-year-old graduate coming into your organisation what that will contribute. Whereas when you're looking at much smaller companies that are 5 years or under, the risks are quite high and quite unknown. So
Excellent. Well, thank you with that, gentlemen, and have a good day.
All right, thank you.
Our pleasure.
Thank you for joining us in this month's podcast. If you'd like to subscribe, please reference your favoured podcast platform. Or if you'd like to provide us feedback, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.